Andrew, Jimmy, or Steven. I see Jimmy on the thing. I just like my mind.
Yeah, where does the Jimmy come from?
I'm sorry. I this is a family account, so Jimmy's our dog.
Woof, woof.
That's exactly right.
Apologies.
Wonderful.
No worries. It's like my mind wanders. So, Andrew, Steven, do you guys want to take a moment to maybe any disclaimers you need to mention or anything like that? Get those off.
No disclaimers from my side.
No disclaimers? Okay.
Yeah, no problems.
Why
Ask
can't
me your
we just-
toughest questions.
No, nothing is issued as trading advice. Okay, perfect.
Okay, that was the main thing. Yeah, this is, thank you for that.
All right. So I'll start off with the same question for both of you. Steven, how did you get involved in trading and what attracted you to it?
So I think a lot of it had to do with the movies, to be quite open. You know, growing up, I watched movies like Wall Street and more recently, you know, Margin Call. And so I think there's a certain purity to trading. It's like it's meritocracy. It's just it's about efficiency, risk taking, consistency. So I just, you know, for me, and it's a concept that is kind of, I mean, my undergrads in history, I think trading is what has propelled. It's not greed that works. It's trading that has propelled humanity from, like, you know, farmers to marketplaces and to today. So there's just something very intellectually and practically compelling about trading that I've always been drawn to.
Yeah, if we look at history, it's always the speculators who mess things up, though, right?
Right.
And if you look at what's happening now in the world, you know, it's like a fascinating twist on reality to some degree. This whole kind of retail explosion, you know, on the back of manifest value through cryptocurrencies, and the idea that you know, if you put a large enough audience together, you can move the price of anything. You know,
Absolutely
fascinating and exciting, and it's a great time to be involved in the space.
Right. So if my answer was a bit too academic or before that, Andrew, that's exactly what I'm talking about. It's kind of a microcosm of society, and like, yeah, what's going on with the meme stocks, for example, it's a look into society or a manifestation of what's going on. It's incredible.
Yeah, and how things are changing, like how people's perception of like where value and opportunity lies. You know, the idea that you don't have to have 20 years experience as a trader on the floor. Like, you can come into it blind with a novel idea, and you can build an audience around something that's, let's use the word contrarian. You know, it's really fascinating. And I think that's really one of the great reasons why the space that we're in, this kind of idea of the synthetic derivative, the derivative that isn't ever matched by the underlying, a leveraged opportunity to participate in the market. The kinds of investment theses that we see, all the time are very different to what you've seen in the past. You know, the ability to build algorithms and to build them quickly and to iterate and to innovate, to use to take 50 strategies and smash them through an AI and come out with, the best 7 for the best set of circumstances. It's like, it's an eye opener, and that I guess would be one of the reasons why I'm so interested in the space. Like, I came to it from when, just when cTrader was coming out. MetaTrader had been out for a long time, but the synchronous nature of building algorithms in MT4, the MQL language, wasn't that interesting. And so cTrader came out with this asynchronous solution, built on the C language. And all of a sudden I find myself just like, smashing through data to try and find some contrarian idea that I could take to them, I could put into the market and turn into an opportunity to create uncorrelated alpha. And so that was where I came to it from. Like, I've just always been in love with the kind of maths and the statistics of it.
What kind of contrarian data would you be looking for? Because, don't you get smashed if you go against the trend? The trend is your friend.
No, I mean, but I mean, you could also argue, and again, I'm going to use simple examples here. Like, you could also argue that there is an opportunity to participate in mean reversion, which isn't driven by, you know, a market moving in one particular direction. You could also argue that there are simple strategies, and again, I'm really oversimplifying here. You could argue that there are simple strategies using moving average, convergence, divergence that would deliver returns. And in fact, when I built my first institutional algorithm, which was called Evolution, it was built on a support and resistance algorithm called a support and resistance indicator called highs and lows resistance, which was basically like a really simple short and long-term moving average complexity. And I was able to deliver, you know, over a reasonable period of time and grow reasonable assets an 11% compound annual return with a 4.5% volatility. And so lots of money trying to trade synthetic derivatives with a really, really overly simplistic investment thesis. And so, yeah.
What is exactly mean reversion for the audience out there? So when they look at the charts or their stats, what does mean reversion mean to them?
Well, the simplest idea of mean reversion is martingale or grid strategies. The idea that without having any insight into price, if you take an incrementally bigger position, hoping that you don't run out of bankroll, that at some point in time there will be a revision in price, you know, in the opposite direction, the extent to which you will recover your money plus some incremental gain. And so thousands and thousands and thousands of people who start in this space, whether they're playing on cTrader or on MT4, will start with some grid strategy. They'll start with some buy-sell strategy where you make a buy and a sell and double your cost of transaction because you think that there is a novel idea that hasn't been considered already, and an opportunity to participate without what's the appropriate without the idea that that price doesn't have an impact on your ability to extract small incremental alpha out of the market. So that's mean reversion. Mean reversion is like at some point price will return to its normal. And so
the first time I learned about martingale was in my first year of university. We lived in a town that we went to university in a town that had a casino right across the border from Detroit, from Canada, and everyone's getting their checks from the government to pay for their school, and they're like, well, you know, let's go to the casino first. And the guy's like, I got this amazing strategy. He's like, I go to the roulette table. I put 25 down on red. He's like, if I lose, I put 50 down on red. If I lose again, I put 100 down on red. And if I lose, I put
yeah, it's your standard +1, you know.
Yeah, he's like, it shouldn't hit, you know, more than 6 or 7 red blacks in a row before I get my red. I was like, oh man. Saw a few people leave university after the first week after that.
But interestingly, though, there are some mean reversion strategies, like high frequency mean reversion strategies can work, because you never put you never put the last trade, the full value trade at risk. So you have an opportunity to participate thousands and thousands of times for tiny and small outcomes, as long as each of the instances of the algorithm are sufficiently different from every other one. I hope that makes sense. Like there is a way to, and I'm not talking about martingale here. I'm not talking about your 1, 2, 4, 8, 16 +1 outcome. I'm talking about like a grid strategy that is conscious of price using fundamental overlay, so a knowledge and understanding in a fundamental way of price, and all of the technical analysis that would support it. But the idea that you can participate thousands and thousands of times without ever exposing substantial capital. So there are lots of ways to spin it. It's not to say that they can't work; they can work, but just the kind of raw 8 hands of blackjack to get $25 back. Those are the ones that don't work. But it's always a great place for people to start, you know. But again, yeah. I guess we're not here to talk about like underlying trading strategies. We're here to talk about, you know, how how to connect with real money, you know?
Yeah, well, my next question was going to be about trading strategies, but to get back to Steven's point, the movie that I watched as a kid was Trading Places, and like I just love the rags to riches, part of it, and how money changes people. It was interesting, and I didn't know there was any nudity in there until I got to like high school, and our high school economics teacher was like, "You guys should watch this movie," and he was like, had a smile on his face. I was like, "Whoa, there's nudity."
You knew, man, because you'd already seen it.
No, I watched it on cable TV, so all the nudity scenes were blocked out. I was like, I had no idea.
Well, that movie had some actual like trading substance, and what fascinated me about that movie was it wasn't about stocks and bonds; it was about commodities, which you didn't see that often. So that was, and it actually had some sound financial or economic information in it. It was, a great movie though, classic.
It feels like that was a much more simpler time to put together ideas that, flow, because now all of a sudden, like there's nothing, when you think you put together an idea that's correlated and, okay, when this happens and this should happen and that should happen, but it doesn't happen, you're like, why are these things not playing out? Well, if interest rates rise, how come this didn't go down or up? And you're just trying to like figure out, well, was it? And then it's like it was already priced into the market, the move.
Standard answer. Yeah, exactly. And the pricing in is now happening in like longer periods of time. Stuff's being priced in a year ago. For the today's move in gold.
Yeah, exactly. But who knew about this?
Yeah, it's fascinating.
Well, I know, Stephen, you did some stuff for some like multinationals and their currency hedging. What does that look like? Because some of the strategies that can really make money, like the institutional grade strategies, they follow the money and the movements from multinational large companies and stuff like that. So I think that's also where you get those big daily spikes in the market, is when big companies are starting to like put in their orders to start their own hedging. What does that look like?
Exactly. And that's why we had large companies, with working with big banks or other FX providers with their own internal teams of treasury people reaching out to us. So I think there's a good segue here from what Andrew was talking about, and picking up on the themes of being a contrarian, and kind of this algorithmic trading. We implement a discretionary strategy, a discretionary approach, and even in a case where you're dealing in a situation where you have a multinational, semiconductor company with customers and suppliers all over the world and dealing in high volume transactions, at the end of the day, people still want a human to analyze everything. It's like everything we just talked about, there's all this chaos happening. And I saw a lot of it in the ad tech space as well, disrupting the mortgage space, the retail trading space. There's just a lot of chaos happening. And at the end of the day, you still need a human to kind of review everything and process it and strategize. So I think in that context of working with multinationals and sophisticated industries like apparel and semiconductors, and they've got all this information, they still want a human. So I'll give you a very simple example. They got a lot of information, a lot of quote free information from their banks on FX, a lot of forecasts, a lot of analysis, but at the end of the day, they wanted us to review everything because they didn't trust the upsell from the bank. So even if they got a generic monthly recap of a certain currency pair, they wanted an independent human to review it because they were suspicious of the bank trying to stoke fear and upsell. So
And interesting you say that, because that's one of the things that creates the consensus view, which is the thing that drives price. Like if you have enough banks saying that the euro is set to rise because there is inflation in Southern Europe, like the more people that say that, the more likely that is the outcome.
Exactly.
So it's really, really interesting.
Our research director, Kevin Solid, he's quite brilliant in this regard. And again, a twist on the contrarian theme. We do major currencies, but we also look in non-traditional crosses like GBP, AUD, New Zealand yen, Euro, Canadian. And then I'll just cap it off with this idea that AI is like Skynet on in movies like The Terminator. The current technology, as far as I understand, you still need a human to place data, images, whatever the AI is processing into initial piles under certain categories. So there's still a vital role for human discretion. Anyway.
But also, and again, I think that's one of the reasons that makes the market, this kind of idea of efficient markets, is that there are sufficient participants. You have a guy who sits in a small room with 7 other developers building out AI strategies, but you also have a guy who sits at a desk looking at a chart going, well, this is the top of a 4-hour candle, and it's reasonable to assume that statistically it's likely to fall. And so if you have enough people participating in different time frames on with different strategies, computers, not computers, AI, algos, fundamental, technical, hybrid, that creates organized price. And so that's one of the things that makes trading so difficult and yet so profoundly interesting. Yeah,
well, I think that's like one of the quickest growing fields is data analysts. There's always ads for data analysts in all sorts of fields now. Data is the new commodity.
Yeah, it's interesting, man. Things you don't understand, right, are the things that you kind of you find a guy who knows a little bit more about it than you, and you bolt onto his objective. And if he's been slightly successful at it, especially in the new world where nobody wants to actually go to a job, they want to find their own way to their own paradigm of success, and it's generally to disrupt something, So yeah, it's an interesting time for humanity in general.
Yeah, definitely an interesting time for humanity. But hopefully we'll be able to leave our houses soon. So
yeah.
So we touched on strategies a little bit. I do want to know a little bit about your trading strategies and kind of how you put them together and how you look at the markets. So I'll start with you, Andrew.
Well, you know that I'm an administrator. I used to be a manager, and I built a platform to support the fragmented nature of managers in the space. So I started as a manager. I built out, as I said, this alternative investment strategy called Evolution, built on this contrarian idea of highs and lows resistance indicator. But in trying to attract capital, so I'll start with the fact that it turns out that there are lots and lots of really, really great strategies that have no assets because they have no distribution. They have no way to connect with customers and capital. And there are lots and lots of really rubbish strategies that have, hundreds of millions of dollars of assets because they've got enough guys with red ties and Rolexes out there connecting with an audience. So we look down at this problem where it's very, very fragmented for the manager. It's hard for the manager to connect with introducers. I'm going to use the word introducers, but I mean like IFAs and wealth managers and introducing brokers, because there are so many strategies out there, and lots of them are really just trying to show you that they can outperform everyone else. Like the numbers are bigger, and it's not about the returns. It's about the size of your Rolodex. Anyway, so we built this platform, which is effectively a distribution ecosystem for alternative investments. And so our objective is to take these derivative alternative strategies like the one that Steve and Kevin trade, and connect them with the long run investor, the guy who's going to stay invested for far longer periods of time, because there's just as much money to be made out of those guys as there is out of short-term trading strategies that are successful for periods of time and then either destroy capital or underperform for periods of time. And so we're just trying to build out an ecosystem that connects talented alternative investment skill with long run investors, where the audience is probably 50 or 100 times bigger than the audience for standard retail managed accounts. And so that's what I do. I'm not a trader anymore, just an administrator.
Well, I'll say we love your technology, Andrew. FYI, everyone, we license out Andrew's technology. We've got a white label. We call it Intelligent Portfolio, and yeah, we love it for both investors and managers. It's a good way to kind of control everything there, and investors love the way that all the information looks in a nice, tidy manner, and yeah, it's easy for traders to get on there.
Yeah.
Stephen, how would you summarize your trading strategies?
So we're discretionary. We implement a discretionary, global macro approach, which is a fancy way of saying it's kind of old school. It's non-algorithmic, and it's kind of qualitative. So it involves everything. So again, Kevin Solid, our research director, is a big part of that. He kind of cut his teeth before the internet kind of broke everything open. So the main factors that kind of feed into our approach are discretionary by nature. So that involves looking at fundamentals like rates and policy and technical analysis. And if I can get a little technical, specifically things like Fibonacci levels and mean reversion analysis, I think that's, Andrew touched on that earlier. Market sentiment, CFTC commitment of traders report, and a lot of phone calls to different desks. So it's a human looking at the news, looking at the chaos, looking at the trends and data, coming up with a trading thesis and kind of following through with it, and implementing a strategy and managing it. Now, in contrast, when we get asked this question by clients, we mentioned we're non-algorithmic, and an algorithmic trading strategy is as quick and as good as the assumptions that are kind of built into it. I'm speaking in broad strokes. I'm not a technical expert here. I think Bloomberg did a great article recently about what happened to algorithmic and quant funds, especially post-coronavirus. They weren't able to adjust or revise the programming of their algorithmic trading programs for that kind of a quick and disruptive event, and they suffered. So, we are what we're not. So we're not algorithmic. We're discretionary, and at the end of the day, that involves discretion in analyzing and executing on multiple sources of data.
Do you find that there are kind of key descriptors in pouring through the information in order to make these discretionary decisions, or do you find that those ideas are changing all the time as well? So when you talk about a thesis, it tends to be something that would sustain itself for a period of time. I don't know, let's say a thesis would last for, if you could quantify it in terms of time, for 5 years. Do you think that you could apply the thesis and the parameters that describe the thesis consistently using the information at hand, for long periods of time? Or is the thesis adjusting as the market adjusts, the thesis shifting as the market shifts?
So that's a great question. I think, before it was the former. And as an example, I remember reading something on CNBC like back in the 70s, when everyone was getting their news from printed newspapers, the stock market might change like the band of volatility in the stock market was, a couple of points over the course of a year or more. I mean, it was, but now it's like, 700 points in a day and no one really worried, and then the next day recoups 90% of that. I think to answer your question, it's, in the old days, it was the former. Now with this overload of information and the kind of constant feed of information, it's the latter. But a discretionary approach can be flexible in that now the data might be fast and furious and the volume might be a lot more, but again, having a human kind of processing it creates a bit more flexibility and discretion, if you will, versus something that's pre-programmed. That can also be very agile, but it requires some. It's not it's a little bit different. It's like retooling a factory versus, having a guy working with his hands. But
yeah,
I've seen enough algorithms just spaz out and start putting in like hundreds of thousands of orders, and just algorithm got broke. So discretion is.
I think transparency is a big help, and that's why Andrew's technology is just, fantastic, a huge disruptor. It's, again, I've seen this in ad tech. This is why we're licensed as a CTA. We're all about transparency, and that's what I think Andrew's technology brings, transparency into other trading strategies, trading experts. So we're big fans of it as well.
Yeah.
Well, I got a question. I got a question from the audience. Mike to go was asking, probably directed at Andrew, how is, I'm assuming it's the Intelligent Portfolio, the Union platform, how is that different from social trading, or what are the nuances there?
Well, okay, so the starting point for social trading is ranked lists. So a ranked list is a place that you go and you can scroll through the best performing strategies over, some metric. So whether it's a week, a month, 5 weeks, whatever it is. Whereas our platform is built around non-disintermediated distribution. So what would happen is that you would come to Scandinavian Capital Markets, you would sign up as a manager. We would build a strategy, which is effectively your strategy, and on top of that, we would build what we call a microfund for distribution. And that microfund itself is branded. It matches your identity, and so you can take that unique microfund built on the strategy of a single manager, and you can pass it into your audience without ever having to worry that you're going to compete for capital from the ranked list. So no one would ever see your microfund fact sheet unless you'd shared it with them. So there is no place where you can go and find the best performing strategies, because what happens then is, as we know, money moves from place to place very quickly. You'll stay in a place for a short period of time until it fails to meet your expectation, and you'll naturally assume that the thing that performed best over the last month is the place that your money should be. And in fact, there was a paper written in 1981 by some dude called Myopic Loss Aversion and the Equity Risk Premium Puzzle, which you should definitely have a read of. And it basically describes that, the idea that psychologically, people are far more likely to move from a small underperforming investment to a small underperforming investment, the extent to which they destroy capital on a far grander scale than if they just stick it out, small incremental success over time. And so that's basically what we're trying to do. A social trading would allow you to take the trades of someone else. We're trying to build an alternative investment product for the discretionary edge of every long run investor on earth. Mike to go, thank you.
Thank you, Mike to go. And please throw your questions at us. I've seen way too many investors just hop in, hop out, and trying to chase the hottest thing. And the flavor of the month it was last month's flavor. If you're hopping in after you see that something, it's normal. You need to let a trade theory or a thesis kind of develop over a couple of months. And if you're just, when you see it happen, the results over that 1 month, it's probably taken a few months for that trade to play out. Otherwise, you get stuck going to a strategy that's over trading and got lucky 1 month and might be unlucky the next month.
Exactly. On top of that, you consider the idea that every person connected to trading and from the world of trading has slightly irrational expectation of return, and so part of the job that we're trying to fulfill is a slightly better organization of that irrational expectation. So the idea that you can have a product offered across multiple risks, and you can participate in that product, that strategy, that microfund, within the bands of your risk expectation, within that kind of risk premium. The idea that long run equities has done 10%, and so how much excess return would you want for the excess risk? And so that's kind of the space that we play in. Definitely retail, but more pushing that retail sales objective into the longer run investors. Yes, Michael, sorry.
Well, I was going to say you explained a little bit from the trader side. What about from the investor side of things?
Well, so the investor gets their own fact sheet, and I think that's basically what a microfund is. So if you imagine what a fund is, where a bunch of people put their money into a pot and you get a fact sheet at the end of the month, a microfund is the description of a single investor's capital. So it's a perfectly described, live, liquid, and transparent reflection of your investment. You know, whether you've put in 50 grand or 5 grand, whether you've put in 100 grand and taken out 6, it perfectly describes exactly where you stand in real time in terms of your investment. And every investor gets their own microfund, and so it's a perfect reflection of their and it's also perfectly segregated. And I think that's a very important piece. It's perfectly segregated the extent to which your money is not in a pot or a pool with anybody else's money. A decision made by a trader is passed perfectly per unit of risk and per unit of capital into your account. The trades are papered on your account, and so your investment is a perfectly ring-fenced example of Stephen's strategy.
Yes, and Andrew, this is why our approach dovetails with Andrew's technology. It's the transparency, and from the perspective of the viewers today, including kind of individual or retail investors. It's about transparency and resulting security. So this is what I mean when we say our approach dovetails with Andrew's technology. A CTA offers managed accounts. So that means individual investors open up their own accounts, they put their money in their accounts, and they keep their accounts and their funds. We can't touch those funds. We can trade those funds via technology like Andrew's on the backbone of like MT4. But that and coming from a fintech, ad tech background in consumer finance and a focus on compliance and consumer protection finance, I think that's a world of difference than going on some mobile trading platform and getting trading signals from whoever, who knows who. There's just that much more transparency and control over your funds.
And we're talking about money, right? Like money is, it's sacrosanct to people, how much they have and how they grow it and where they put it. And so you've got to be very, very careful of that. This is a serious business. And so we take it very seriously, and much like you do.
Yeah, I had a buddy this week. He's like, hey, Michael, he's like, I invested in this FX thing. I was like, why didn't you come talk to me before you do anything like that? He's like, yeah, I spoke to someone and they told me I could make, 6 to 20% a month. And I'm like, okay, send me everything you know. And like, I'm like, how did you send the money? He's like, well, I sent, they made me transfer money to Bitcoin and then send Bitcoin to this address. I'm like, did you send it to a brokerage? He's like, no, I just sent it to this wallet address. I'm like, show me your brokerage account. He's like, no, I don't have a brokerage account. I just have access to a back-end platform that tells me how much percentage I made every day. I was like,
genius.
I was like, no.
But maybe he'll make 6% this month or 20.
I know. When the time comes to withdraw, that's when he'll find out what really happens. I was like, no. But speaking of the crypto space, we got a question from Locks Trading. What are your views on crypto and currencies that suddenly gain popularity like Dogecoin? Well, before I even let you guys touch that, Dogecoin is a meme, and apparently that's a meme that got really popular, and people just said, okay, this meme is fun, let's just throw money behind there, and it got really, really big.
Yeah, it's crazy.
So I think I don't even know what the frick a meme is. I feel like I'm an old fuck, but I don't know. What do you guys think about that question?
Yeah, I mean, crypto is interesting, and it's definitely organizing itself much better than it has, in the kind of early days. It is manifest value though. Like it's hard to quantify, but by the same token, 250 years ago, if you were panning for gold in the southern parts of South Africa, you probably couldn't quite rationalize why you were there panning, because it's just this kind of shiny object. And so perhaps the moment you can organize it as something that you can, so it's the moment people can rationalize it for themselves, then its manifest value becomes tangible value. And so there's lots and lots of argument around why it's valuable, and there's lots and lots of argument about why it's not valuable, but you can't argue its ascension. You can't argue how it's risen over time. And but if you think about how the conversation and the debate and the argument has raged over time, whether you were polarized by the idea that you hated it or you loved it, the guys that got on and have been on for the ride have been successful, and those that have the kind of FOMO have also helped to drive its success nonetheless. It's a fascinating space. 5,000 coins, like how is it rational that something that offers, like a Dogecoin that has, like, it's irrational to me.
I think Andrew's absolutely correct. And just to kind of ground that in a more traditional example, with the increase in, there's been a lot of attention as a result of cryptocurrencies on gold. And because of supply chain issues, a lot of attention placed on silver. And, I read this great article arguing that silver should be worth more than gold because practically silver has a lot more applications going on today than gold. But yet that value, the manifest value or the perceived value, however you want to put it in gold, remains. So that's my take on cryptocurrency as well. It's still kind of early. Is it a commodity? Is it a currency? How are you going to actually use it? Those themes that Andrew touched on, I think, are all playing out now.
And interestingly, like those things don't necessarily matter, because if you think about,
right.
and I'm going to move into something slightly esoteric, but like the idea of belief, like you can't tell somebody what to believe. And so if you think about, and again, this is I'm taking the conversation into kind of this retail kind of craziness that's happening. So lots of guys get invested in this thing, and I'm talking about the belief invest. I'm not talking about the monetary invest. And so it's very, very difficult to take that kind of belief structure away from somebody. And so if you can tell enough people in a strong enough way with strong enough facial expression, eventually people will buy into what you're kind of describing. And so whether it goes from $30,000 to $80,000, or whether it goes from 30 down to 3 and then back up to $1 million, like nobody knows. But if you're a believer, you're going to stick to the objective. Like, what is the long run objective? I love it.
It's all about belief. And I see all these things online from like the Gen Zers posting and whatnot, and apparently I think we're Gen X, right? And everyone here on this call, and they're saying that they're calling us Gen Xers freaking baby boomers. I'm like, what the? I'm like, I'm taking offense to that. They're like, yeah, these baby boomers don't believe. I'm like, well, it's like you said, it's all about belief. And then some people these days are believing themselves to be teddy bears, but that's another thing.
Yeah, And you can't take, so this is organized belief. And again, I'm not trying to take it into, the realm of religion, but like, the language and the structure of the way that the information is passed from person to person. It's a belief. And I'm going to use another simple example in terms of the things that have been the most successful in the last, whether they're technical or Brexit or have been the things that polarize people the most. COVID is an example. There are, it's almost 50-50 across the board. So people who hated Twitter when it came out are the same people that made it successful they're the same as the people who made it successful as the people who loved it from the beginning, because you could have a conversation about it. And it wasn't lots and lots of nuanced conversation. It was liking it or hating it. And that is exactly what's helped to drive meme stocks, because you've got the hedge fund manager who's short whatever the stock is, driving his polarized objective against 217,000 21-year-olds with access to a Robinhood account driving the price up. It's that kind of polarity that has manifest these kind of irrational beliefs and pushed lots and lots of opportunities into the stratosphere. Yeah, it's fascinating.
No, I think that's spot on, both of you. And Michael, you touch on a very interesting point about this intergenerational component of it. You know, I don't know. It's burned into my mind that day when the whole meme stock phenomenon broke out with GameStop, and you saw, I forget his name. He's one of the kind of icons of Wall Street. He's on CNBC all the time, and he was, you know, and I'm not making fun of the guy. This is an example of what you're talking about. This, in addition to all this chaos, all this new information, all these moving parts, there's this intergenerational component, and to see, you know, the cliches, you know, people in their basements running with GameStop as a meme stock, and then to see, I forget his name, one of the icons of Wall Street on CNBC, you know, crying. You know, I mean, I don't think you could illustrate it any better. I mean, and that's why when I hear people like Buffett, or I forget, he was the genius in The Big Short, the real life genius, who's
Michael
big
Berry?
concern now is, but Michael Berry, and I listened to him carefully. His talks about his concerns about inflation, and Grantham is another, you know, established Wall Street expert. He's also very concerned about speculation, the stock market being a bubble. I take all that seriously, but then again, the other perspective I have is, we're in a world now where things are just so much bigger, and I mean, they are rooted in a previous generation, so who knows what's going on, you know? And then to see someone on CNBC crying because, you know,
their short didn't play out.
Yeah, it's just it's
yeah, and also, I mean, if you think about Michael Burry and the Big Short, like, the story is told about a guy who was right, you know. And again, this is probably a particularly obvious statement. The movie is made about a guy who was right. There's no stories made about the guy that wasn't right. You know, the guy that's been talking about, you know, the next, you know, the next stock market crash. It's only the guy that calls it to the day that that Miramax writes, that makes a movie about.
Who's that guy? He's on CNBC a lot. He's always saying that the next mortgage really bust is around the corner. Dr. Doom. Yeah. I think he was right once. Yeah, I think he was right once. I think, and then he's, you know, sorry, go on.
No, he's great though. I mean, he's a big hater of the crypto, but he's an interesting guy, you know. But again, you're probably right. He's probably rooted in the world of Keynes and Adam Smith and the invisible hand, when economics has probably shifted. You know, there are probably some really interesting new and kind of novel theses that weren't written in the 17th century. You know.
So, and that's what keeps me up a little bit sometimes at night. When you listen to Dr. Doom or Grantham, or even Michael Burrows, their opinions are based in sound analysis, technical analysis, and yet the market goes the other way. So that's when things get a bit, you know, we're in a new frontier. So again, I think that kind of circles back to, you know, having a human kind of analyzing all these moving parts and all this information and all this chaos, and trying to, you know, translate it into some kind of strategy or some kind of reasonable thesis or assessment. Yeah.
I was going to say that you know, that plays well into the hands of Union as a distribution ecosystem, or the intelligent portfolio within Scandinavian Capital Markets, and that is that it's the storytelling that gets you customers. So if your objective is to go out there and raise assets, you need to be telling stories to more people, because the objective output of your strategy will tell its own tale. But you still have to have a beer with a guy who's prepared to put in 100 grand before you can prove to him that you can make him a 2.5% return over 3 months. And so, this whole game is about storytelling. If you've got a big enough audience, you can spin a yarn to anyone.
Well, touching on like the institutions who learned a lesson with the power of the people. Don't you worry, they've all developed algorithms that scan all the different chat channels now to figure out what they're saying. So that way you can fool them once, but you won't fool them twice.
100%.
And the institutions are in it to make money. And where there is tight margins in other areas, there's big margins in Bitcoin. And that's why they're interested. They're all about the margins, they're all about the fees, and they're all about the ability to, they understand how to move a market and then how to take profit and get in and out. You think the drop from 66,000 to 30,000, is a coincidence? No, it's the big boys understanding how the market works and how to make it work. And it's going to happen again and again and again. And
also the quantum of output is different. So Bitcoin is like this almost pure delta one product. So you can only leverage 1-to-1 because a 10% move is 10%. Whereas if you go into the forex space, like a 20 pip move in euro dollar leveraged at 50-to-1, is a 5% return. So you need leverage in forex where you don't need leverage in Bitcoin. And I'm not suggesting that kind of gap won't change as price rationalizes itself, and that the daily move in, the daily average volatility in Bitcoin, or the average true range, or whatever you want to call it, reduces itself away from 15% to 1%. So just like you say, the institutions, they obviously want to participate, because to take 1% of your investable to take 1% of your investable money and put it into something that's kind of out there where people are expecting you to participate in it is completely rational. As it goes to 5% and 10%, and people start to ask questions about the quantum of movement, that's when it'll kind of rationalize itself. But it'll get regulated before that.
Well,
so don't hang your hat on it. Jokes.
Well, we'll see what GovCoins come out, the central bank digital currencies. We'll see what happens with that. I think that's worlds colliding in that aspect. Stablecoin is an obvious play for the new world, right? Digital money's been around forever. Crypto is this idea of manifest value, and you could do an ICO, which simplifies the path to, it's like venture capital for free. All you have to do is have a 4-page white paper and something that says you're going to launch an app in 2026, and people come running to put money in.
I'm going to recommend a podcast here on point that touches on exactly what we've been talking about. The Tim Dillon Show. He's a comedian. He's just wickedly funny. But he interviewed the Winklevoss twins. This was in the last month or so. I think you'll find it very insightful and because of that, just hilarious. But
how's Gemini done? Because Gemini is their brokerage, right? It's
like one of the top ones out there.
Is it though? I mean, I've seen lots of plans to list these exchanges like FTX and Coinbase, and like big numbers.
Anyway, just had a huge raise the other day. They raised a huge valuation, FTX.
Yeah, it's crazy. Like $18 billion on a $900 million round. A $900 million round.
Yeah.
It's that's a 5% raise. It's crazy. Yeah, I want to know how Gemini's doing, because those Winklevoss guys are only good for one thing, right?
Well, he really puts their feet to the fire. It's insightful and hilarious. I highly recommend it.
Yeah, I'm definitely gonna have a watch.
Tim Dillon. I'll write that down. Well, I was going to ask Andrew, you mentioned microfunds a bunch. What is microfunds? How does that compare to other funds that are out there, or other structures?
Well, so I mean that goes right to the heart of what we do. So we're all about the discretionary edge. So what is the discretionary edge? The discretionary edge is that kind of 5 to 10% of your net investable wealth, because every person on earth plans to retire at 65 with a house and a boat. They're always planning for it. And so in order to build an appropriate portfolio for yourself for the long run, and whether you're starting at 21 or 31, you still need to be well diversified. You need to be building towards your kind of efficient frontier. Microfunds are exactly that. They're in a derivative, which means they're uncorrelated. They're in the spot market, not in the portfolio market. So that means that people are trading in and out, whereas a portfolio is like you take a position in Theranos and you hold that position until it justifies your output. That makes it uncorrelated as well. Lots and lots of the investment thesis are contrarian, which means that you're getting returns that are not the same as the returns you're getting in your traditional funds. And so the only thing that you would expect from a microfund is that it would give you some small risk premium or some measurable risk premium over your traditional. And so if your expectation of your of your traditional fund is a 10% compound return in dollars over 3 to 5 years. And given the risk in trading, in participating in a leveraged derivative product, you should probably want somewhere between 5 and 8% as a risk premium. So, a 15 to 20% compound return over 3 to 5 years, given the additional risk, given the leverage. That's exactly what microfunds are. They're a way to diversify your portfolio away from the norm in a product, in an asset class that is massive around the world with almost infinite liquidity, and an opportunity to, when it's well organized, to get the kinds of returns that you would expect at the discretionary edge of your portfolio. Microfunds in a nutshell.
In a nutshell. And I guess, Stephen, as a CTA, you probably have a lot of reporting requirements, legal things like stuff like that. And it's a good thing you're a lawyer, because it seems like you need to be a lawyer to, take care of all the fund and administration stuff.
So I appreciate that question. So I think this is a good point to remind everyone, we're only giving our opinions. Check with your own financial professional, get your own advice. This is all, this is not trading advice. And I say that seriously, and also in response to what you said, and that's correct. But that kind of goes hand in hand with our approach, where we deal with the equivalent of basically sophisticated investors. So there's, except in our world, they call them QEPs, qualified eligible participants. So they have to meet certain thresholds in terms of experience and assets in their account, in their investment accounts, which mitigates some of the compliance requirements. But bottom line, you're correct. There is a lot of compliance, but that I'm okay with that, because it's about transparency. It's about transparency and looking out for the consumer or the investor, which is why we went with the CTA model, where everyone opens their own account, keeps their account, control of their account, owns their account, and the funds in it. And that, again, dovetails nicely with Andrew's technology, where, again, everyone has their own account and it keeps their own money, and it's only kind of traded or managed indirectly by the expert, by the advisor. But yes, there is a lot of compliance with the investor protection focus, but I think that's a good thing. And that's one big reason we went through the effort to get licensed and to use this managed account structure, because it's baked in compliance or baked in protection for the consumer. And I would say the same thing for Andrew's technology. It's everyone gets their own microfund, their own account. It's baked in, protection, so to speak. And I think it's win-win.
Win-win. And I guess pretty much at the hour, I guess I'll leave it to each of you for some final comments. If anyone's watching and if they want to get in touch with you, how can they get in touch with you and learn more about what you guys are up to? Andrew, go for it.
So if you want to get in touch with us, we're at forunion.com. That's FORUNION.com. And obviously, we're in Scandinavian Capital Markets in the Intelligent Portfolio, and they've got some great strategies, some great managers, some great microfunds. Stephen obviously is one of those. But Michael, thanks for the opportunity, and Steve, nice to chat to you.
Same here. Michael, thank you very much for this great opportunity. Andrew, great. Well, I work with you, so it's great to catch up with you. And we're at ctafx.com. But I appreciate this opportunity. Thank you.
All right. Well, Andrew, Stephen, I want to thank you both. Everybody watching, I want to thank you as well. And we'll be back in a couple of weeks for another episode. All right. Take care, everyone.
Thanks, guys. Cheers,
Thanks. Take care.